Brad Williams, Frugal Finance. How about we talk about home equity loans and home equity lines of credit? Just FYI, I owned a mortgage business for 20 plus years. I pretty much have seen all of the games, and home equity lines and home equity loans are a benefit to a few and detrimental to a lot. And let me just explain what I'm talking about here before getting into the meat and potatoes. I started out in my mortgage business doing home equity loans, but they were construction related. In other words, people were doing home improvements, which is fine because you're working off a draw system, you're doing major improvements, it's an add-on or it's a roof, or if you're doing electrical, or you're doing some significant changes to your house, which is generally adding equity. Then came along the cash outs, where people were using home equity loans not to do home improvements, but to pay off credit cards. Yeah, it's fine, but it becomes this revolving problem, this credit rollover. You just keep doing it over and over and over, because you're not disciplining yourself in terms of your credit card. The home equity lines of credits, for some people, it's a good back pocket kind of deal. For example, if you're in Florida, you have a house that has a ton of equity in it, but you don't want to take out any of the money. You just want to have an emergency source of financing in the event that there was a natural disaster. So you have this home equity line of credit that's available. Let's say it's 200 grand, that there's a modest or just a relatively low cost to have that available. Other than that, the home equity lines of credit, if you start doing some dancing with it, and I've seen people do some really creative things, and creative not being good in terms of home equity lines. They'll take out the home equity line of credit and they'll take the credit to buy other property. They're up to 95% loan to value on their primary residence, and they're betting that the home or whatever they're buying, the property of their purchase, either has a decent cash flow or is purely speculative. I pretty much shut down my loan operation after the meltdown in 07 and 08. These home equity lines of credit kind of led up to the demise. But with that being said, let me just explain to you what's going on here. Home equity loans and lines of credit are ways to use the value in your home to borrow money. In other words, you have a $500,000 house. You only own 100 grand on the first. Okay, I've seen people go out and borrow a second, a third, and a fourth. There are lenders out there. They're called hard money, and they are hard money. They'll satisfy any want that you have. So they'll issue a second, a third, a fourth, and you are responsible. And for every level of loan, there's a higher level of risk, and the borrower's going to charge you. So before you walk down this road, these home equity loans and lines of credit are expensive. And it's not the actual note rate, it's the incremental cost. So what you're doing is you have $400,000 equity, you borrow an extra 100 grand. I can't tell you how many people would email me after the fact saying, hey, we went on a great vacation. Thanks for getting us that home equity loan. Really? A home equity loan to go on vacation? It is common. Or to buy a vehicle, that's common. Because generally, a home equity loan amount is generally going to be lower than a car loan. So people are creative, and I applaud them. I can't tell them what to do. If there's a demand, there's going to be a supply one way or another. So people are just taking out their equity and using it for other purposes. Using the equity in your home to borrow money, your equity is the difference between what you owe on your mortgage and the current value of the home, or how much you could get for your home if you sold it. Taking out a home equity loan or getting a home equity line of credit, it's called a HELOC. It's just an acronym that says home equity line of credit, HELOC. And these are common ways people use the equity in their home to borrow money. If you do this, you're using your home as collateral to borrow money. This means if you don't repay the outstanding balance, the lender can take your home as payment for your debt. It's nothing new. You buy a house, a new home buyer, you're just using that collateral to secure the loan. Well, if you take out a home equity loan or HELOC, you're doing the same thing. As with other mortgages, you'll pay interest and fees on a home equity line or HELOC. Whether you choose a home equity line or HELOC, the amount you can borrow and your interest rate depend on several things, including your income, your credit history, and the market value of your home. In most cases, AAA borrowers, the lender are more comfortable at 80% or less. In other words, if it's $100,000 loans, it's just for simplicity, you have a $40,000 first, borrowers are going to go, well, your loan to value, it cannot exceed 80%. You have a 40,000 first. You have a total market value of 100 grand. Well, the 80% loan to value is 80,000. This is with the best rates and best terms. Now, if you're in a crisis and you need to go up to 90%, or 95%. I know people that borrowed 120% of the value of their home. Yeah, and they kept doing it over and over and over. And every time I did it, I said, stop your spending. Literally, they had $125,000 in credit card debt. And that is no joke. And they were the greatest couple in the world. I loved them to death. But my goodness, there was an addiction. And it wasn't from drugs. They just bought things. I don't know the end story. This was long ago. But you're going to see every possible hypothetical that it becomes reality when it comes to owning a home and people's want for things. But I'm getting off topic here. I'll do that a lot. Frugal Finance. Williams goes off on a lot of tangents, and I may edit this, I may not. But I like to share my experiences with you so you know perhaps you're not alone. And the only way you battle this, if you are so heavily in debt, is you just freeze your spending. Anyway, a home equity loan, sometimes called a second mortgage, is a loan that's secured by your home. Home equity loans typically have a fixed annual percentage rate, fixed. The APR includes interest and other credit costs. You get the loan for a specific amount of money, and usually get the money as a lump sum up front. Many lenders prefer that you borrow no more than 80% of the equity in your home, as I just mentioned. You typically repay the loan with equal monthly payments over a fixed term. It's a simple amortized loan. So you're going to have your first and your second, maybe a third or what have you. And it's going to be 15-year terms are common, 7-year terms, 10-year terms. Again, it's really up to you as to what you want to negotiate. But if you choose an interest-only loan, if you're a speculator, you do this. And investors do this all the time. So don't be shy if you're a professional. You do this all the time. You like that high loan to value kind of stuff. You are a risk taker. You're willing to lose it all. Well, why not just pay interest only? That would mean you're not paying down any of the principal. If you bought a bunch of houses 5 years ago, this would have been a great strategy. Interest-only loans. I'm not saying good or bad. I've seen them all. Your monthly payment goes only towards paying interest. You're not paying down any principal. Well, if you've seen the property value increase from 250 grand to $500,000 over a 3-year period, well, you can see the strategy work. But keep in mind, it works both ways. I've seen this situation where it's interest only, then the loan exceeds the value of the property. Hence 2007, 2008, where people were, it's called underwater. And they just walked away. Pros will do. They'll set this up legally. They'll buy it and put it into a limited liability company. Legal. The deal goes upside down. Well, they just walk away from it. They just hand the keys back to the lender. It's the way it works. Now, you, as a simple homeowner, want to do some improvements on your house. Well, this 80% equity deal works great. This interest-only deal, I would shy away from it. Unless you know for certain that you're going to sell the house in 3 years, hell or high water. That means you don't care about paying down the principal. You're doing a home improvement. You're retiring. You're going to move. You're just going to sell the property and relocate. Then a short-term interest-only deal may be preferable. Otherwise, just do a fully amortized loan. Otherwise, if it's a 10-year deal and you still own, and that loan is due after the 10th year, you're going to have this huge lump sum payment. In other words, you borrow 100 grand, you didn't pay down any of that principal. 10 years, you either refinance it or you're going to have this huge balloon payment at the end of the loan. The balloon payment is often large because it includes the unpaid principal balance and any remaining interest due. People may need a new loan to pay off the loan payment over time. Well, again, if you're in a bull market, it's in the lending market or Wall Street, you don't care. But otherwise, if you want to take the conservative route, you just do a typical fully amortized loan. Home equity lines of credit. A home equity line of credit, or HELOC, is a revolving line of credit. Revolving. It's simply a credit card, if you will, on your house. Similar to a credit card, except it's secured by your home. I've seen these go really bad. But I've never really believed in these things just because there's just too much convenience and what have you. Let's go on. These credit lines typically have a variable APR, so they're going to be tied to, let's say, the 1-year treasury rate. And with rates moving lower, you're going to see this variable rate change. If interest rates are moving higher, you're going to see the teeter-totter effect. Good or bad, keep that in mind. The APR is based on interest alone. It doesn't include costs like points and other financing charges. The lender approves you for up to a certain amount of credit. Because a HELOC is a line of credit, make payments only on the amount you borrow, not the full amount available. In other words, if you're a small business owner and you have a lot of equity in your house, it's not uncommon to have a line of credit. And it could be a seasonal kind of deal where you have to ramp up prior to the holiday season, for example, and you need to buy $100,000 worth of inventory to weather the holiday season. Then you can pay that line of credit off in January or late December, and you're good to go. But you're going to pay interest. Let's say you bought in September, went out and you spent $100,000 in September with the intent of paying this off in January, where you're going to pay 4 months of interest, whatever that going rate is, and then you can pay the whole thing down in January. That's the benefit if you know what you're doing. Letting this credit extend over and over and over, and all you're doing is paying the minimal amount. Now you have a credit card. You can see the problem there. Many HELOCs have an initial period called a draw period where you can borrow from the account. You can access the money by writing a check, making a withdrawal from your account online, or using a credit card connected to the account. During the draw period, you may only have to pay the interest on money you borrowed. After your draw period ends, you enter the repayment period. During the repayment period, you can't borrow any more money, and you must start repaying the amount due, either the entire outstanding balance or through payments over time. If you don't repay the line of credit as agreed, your lender can foreclose on your home. Keep in mind, these are typically seconds. So the problem here is it's a process. But if you have a second, you can still foreclose on that property. However, the person in first position, you're going to have to dance with them because they're going to demand payment before you see a dime. In other words, you as the second need to keep apprised of the total value of the property. And you're not going to get a dime before the first. First has priority. Lenders must disclose the costs and terms of a HELOC. In most cases, they must do so when they give you an application by law. A lender must disclose the APR, give you the payment terms, and tell you the difference between the draw period and the repayment period. Again, this was a 2006, 2007 little bit of a problem. In other words, unsophisticated borrowers were coming in, they were borrowing 80%. Then the lender was going, well, just take this HELOC for an additional 20%, and we're going to give you this sweetener. We're going to give you this 1-year deal with interest only. And you're going, well, sign me up. Well, they didn't tell you all the caveats. And that is, you have this sweetener that turns into this really nasty term after the fact. So they'll say, well, we'll give you a 5% interest only, but they don't tell you it's tied to the 3-month most aggressive index. And that could have been LIBOR back then. They'll say LIBOR plus 4%. And you're going, what are you talking about, Williams? That's the problem. If you don't know the language, if you don't know what the APR is, if you don't know the terms and conditions of the loan, you're going to find yourself, you thought what the lender was saying up front, oh, your monthly payment's only going to be $600 a month. They don't tell you after the 1-year period, it doubles. Yeah, it goes from $600 to $1,200, hypothetically. And people are going, well, how'd this happen? Well, you didn't read the terms. You didn't ask the question. You fell in love with the notion of owning a house, only to find that you got scammed. Yeah, the lender also must tell you the creditor's charges to open, use, or maintain the account. For example, an application fee, annual fee, or transaction fee. And again, this can get really muddy, if you will, if you don't understand all the fees. And when I was a loan officer, look, I don't think I ever did a HELOC. I think they're horrible and seconds serve their purpose. But when I sat down with a client, I would try to explain this the best I could. And sometimes in the closing, the people are they're so enamored about buying a house, or they're so overwhelmed by the paperwork. If you bought a house in the past, you know, you're going to have a note, you're going to have a deed of trust, you're going to have all your fees, all your charges, the insurance information, you're going to have an escrow officer who's on the clock, who has 45 minutes to get you in and out. That means both buyer and seller. That's just the way it works. They're pushing you along, and it's not fair, but that's just the name of the game. So if that's the case, and I've said this time and time again, it'd be it a first or a second or a combined first and second, whether you're refinancing, you're doing a home improvement, you're doing a HELOC, get a copy of the information beforehand. All you do is ask the escrow company for a copy beforehand. They'll give it to you. Most people aren't aware that they can do that. Get it 24 to 48 hours beforehand because the language it's all in legalese. So take your time and read the information. Disclose. The lender must disclose additional charges by other companies to open the line of credit. For example, an appraisal fee to get a credit report, or an attorney's fee. Now, keep in mind, when you're doing a second, lenders will have what's called a drive-by appraisal. A drive-by, not a full appraisal. A drive-by appraisal is about 65% less in costs. Just be sure that if you're going this route, I just want a drive-by appraisal. And again, that's just negotiable. If you're looking at a huge loan to value, if you're going above 80, the lender's going to want a full appraisal. And now a full appraisal is probably $1,000, $1,100, as opposed to a drive-by, which is $250. And literally, it's just the appraiser is just going to look at comps online. He or she may just take 3 photos of comparable homes surrounding your property. It's usually a 1 mile radius circumference. So if you go a mile out in any direction, the comps are respective of the values in that general area. Keep in mind, if you live in a rural area, you may be stuck with a full appraisal because there may not be any comps close by, and the appraiser is just going to have to go out and find something comparable, and it could be a few miles away, and then they'll have to justify in writing. The lender must also tell you about any variable interest rates, the index, and any additional rates. In other words, you're going to have some index, and then you're going to have whatever the add-on is, and it could be 1% or 2% and adjust on an annual basis or every 6 months or what have you. The lender also must give you additional information at opening of the HELOC or before the first transaction on the HELOC. For more information on choosing a HELOC, what should you know about home equity lines of credit? And I'll have this video, and it might be back to back here, or just do a quick search on YouTube to see if produced this video yet. And again, this is from Federal Trade Commission. I'm just adding my anecdotal or my experiences because the federal government actually does a really good job explaining this, and I'm just reproducing this or reintroducing to you. Closing on a home equity line or HELOC before you sign the loan document papers, read them carefully. As I've just stated, crossing the T's, dotting the I's. If the financing isn't what you expected or wanted, don't sign, period. Negotiate changes or reject the offer. Walk away. Walk away. I can't tell you how many times I would hear that, and this was public knowledge. This was published in newspapers that people, when you're buying a property, it used to be a 30 to 60 day process. And there were a lot of contingencies. One, it was, the seller was probably buying another property. You may have been selling a property. So timing all of that, it was slow back then. The underwriting process was cumbersome. And it was all literally a person having to check everything manually. Now everything's automated and you can get a loan approved in however long it takes to input the information into Fannie Mae or Freddie Mac. And I'll explain all that later. So now you could buy a house in 48 hours, maybe 72 hours if it was cash. Otherwise, you could do it in 15 days comfortably. 1 week closes are common. But again, it's contingent on a lot of variables. If the house you're buying, for example, or if it's a HELOC and the appraisal is just a drive-by, that could be one of the areas that slows the entire process down. You may have the appraiser might be so backed up that it could take them 10 to 12 days to get out there, and then a few days to do the actual appraisal. Today, most of it is automated, so you can move pretty quickly through this process. Point is, if you don't like the terms, walk away and go back and find another lender. If you decide not to take a HELOC because of a change in terms from what was disclosed, such as the payment terms, fees imposed, or APR, the lender must return all the fees you paid in connection with the application, like fees for getting a copy of your credit report or an appraisal. Now, keep in mind, your free credit report is not the same as what the lender is seeing. The lender is going to get a consolidated credit from all 3 credit agencies or more, and they'll look at the 3 and they'll average the FICO score. So your free copy is not one that's acceptable, or even giving them 3 free from the credit bureaus isn't the same. And the reason being is what the credit bureaus provide the lender is much more comprehensive. Avoid mortgage closing scams. This is one area that just pisses me off. And you're going to read about it. It happens more often than you would imagine. And that is scammers will go in and they will claim to be the escrow company that you're working with. How they get this information is a mystery. Well, let's say you're working with ABC escrow company and the scammer emails you saying, look, we had a change in plans or there's a last minute change. They might ask you to wire the money to cover your closing costs to a different account. Don't wire money in response to an unexpected email. It's a scam. If you get an email like this, contact your lender, broker, or real estate professional at a number of email addresses that you know is real and tell them about it. Scammers often ask you to pay in ways you make it hard to get your money back. No matter how you paid a scammer, the sooner you act, the better. So before you wire any money, and this is not your responsible. This is the responsibility of the escrow company. All right. So what you do is you set up a wire through your escrow company. In other words, you are physically, a lot of cases you can't do this, but you physically go to the title company and you give the account information to the escrow company and you let them request the wire. So your hands are clean. Then if there's a problem, then the escrow company is responsible. But for you to wire money, I've seen a lot of foreign transactions, buying property in different countries. Well, make sure you're wiring the money to the party you're responsible for. In other words, it wouldn't hurt to be online or to be on the phone with the title company. You're always going to work with a title escrow company. Doesn't matter where you are. And make sure that you are in sync with that group. In other words, saying, look, let's confirm this particular account number. Let's confirm who you are. And then, don't be shy to hang up and call another number within that group and then go online. I mean, there's been cases where people have lost $750,000. The money was wired to a scammer. Just be extremely careful. Your right to cancel. The 3-day cancellation rule says you can cancel a home equity line or HELOC within 3 business days for any reason and without penalty if you're using your main residence as collateral. Keep that in mind. You have this 3-day right of rescission. That could be a house, condo, mobile home, or houseboat. The right to cancel does not apply to vacation or second home. And there are exceptions to the rule, even if you're using your home for collateral. The rule does not apply when you apply for a loan to buy or build your main residence, when you refinance your mortgage with the current lender and don't borrow more money, when a state agency is the lender. In this situation, you may have other cancellation rights under state or local law. Waiving your right to cancel. The right to cancel within 3 days gives you time to think about putting your home up as collateral for the financing to help you avoid losing your home to foreclosure. But if you have a personal financial emergency, like damages to your home from a storm or other natural disasters, you can get the money sooner by waiving your right to cancel and eliminating the 3-day waiting period. Just be sure that's what you want before you waive the important protection against the loss of your home. To waive your right to cancel, you must give the lender a written statement describing the emergency and stating that you're waiving the right to cancel, and then the statement must be dated and signed by you and anyone else who owns home. Cancellation deadlines, you have until midnight of the 3rd business day to cancel your financing, because business days include Saturdays, don't include Sundays or legal public holidays. Keep that in mind. For a home equity loan, the clock starts ticking on the first business day after 3 things happen. You sign the loan closing documents. You get a truth in lending disclosure. It outlines key information about the terms of the loan, including the APR, financing charge, amount financed, and payment schedule. And you get 2 copies of a truth in lending notice explaining your right to cancel the contract. If you close on Friday and get the disclosure and 2 copies of the right to cancel notice at your closing, you have until midnight on Tuesday to cancel. For a HELOC, the 3 business days usually starts to run from when you open the plan or when you receive all material disclosures, whichever occurs last. If you didn't get the disclosure form or the 2 copies of the notice, Or if the disclosure or notice was incorrect, you may have up to 3 years to cancel. All right. You may have up to 3 years to cancel. In other words, if and in the loan industry, you have a lot of behind the scenes people, they're just loan processors and they get distracted all the time. It's not uncommon for these disclosures to not show up or you don't get copies. Keep that in mind. How to cancel? If you decide to cancel, you must inform the lender in writing. You may not cancel by phone or in a face-to-face conversation with the lender. Mail or deliver your written notice before midnight of the third business day. In this day and age, mail or deliver. Okay, well, you can't use the United States Postal Service because it'll take 9 days for a letter to be delivered across the street. I'm not kidding. I mean, the United States Postal Service just is lacking. So this is going to cost you some money. You're going to have to do an overnight deal with either FedEx and do your process and pay that fee. After the lender gets your request to cancel, it has 20 days to return any money you paid, including the finance charge and other charges like application fees, appraisal fees, or title search fees, and release its interest in your home as collateral. If you got money or property from the lender, you can keep it until the lender shows that the home is no longer being used as collateral and returns any money you've paid. Then you must offer to return the lender's money or property. If the lender doesn't claim the money or property within 20 days, you can keep it. All right. Well, see, again, the lenders can get sidetracked, and it's their responsibility. Your rights after accepting a HELOC. In a HELOC, if you make your payments as agreed, the lender may not close your account, may not demand that you speed up payment of your outstanding balance, may not change the terms of your account. The lender may stop credit advances on your account during any periods in which interest rates exceed the maximum rate stated in your agreement, depending on what your contract says. Be careful. Read your contract. Let's say, here's a hypothetical, you're a small business owner. Interest rates have risen, but you have to buy some inventory, but your account has reached its maximum credit, the line, but the interest rates have maxed out. And you'll have a cap, you'll have a ceiling. If it's reached the ceiling, you may be cut off per the terms of your loan. Be sure you recognize this. The lender may freeze or reduce your line of credit in certain situations. For example, if the value of your home declines significantly below the appraised amount. Literally, I just got to interject this. Back in the heyday, people were borrowing 120% in a declining property value market, 2006, 2007, 2008. They're borrowing 120%. And then knowing that the lender was overreaching. And trust me, Countrywide did this. Countrywide Mortgage at the time was the largest mortgage lender in the United States. Hence, they're no longer around. They were just giving away money for practically nothing. So 120% loan to values were just, well, it was crazy. Needless to say, I was on the sideline watching this. I was a very conservative mortgage broker. I didn't play the games, but I know people who did. Clearly, in a declining market, lender's probably going to cut you off. If the lender reasonably believes you will be unable to make your payments due to a material change in your financial circumstances. If any of these things happen and the lender freezes or reduces your line of credit, your options include talking with them about restoring your line of credit, getting another line of credit, or shopping around for another mortgage and paying off the first line of credit. It's not uncommon. All right, you have a credit card. You don't like the terms of your credit card. Well, there's over 14,000 different credit cards available. 14,000 in the United States. 14,000. You think there's some comparison shopping there? So when you go online, you go to any of these social media deals and they go, here are the best 10 credit cards out there. I have to laugh. There's 14,000 out there. You need to read the fine print and see what commission they're getting. And there's healthy commissions from these people marketing this stuff. Be cognizant that if you're shopping around, it takes time, but it could be well worth the investigation. Again, Frugal Finance. The reason I use Frugal Finance is, well, I named it Frugal Finance is because we're in a competitive market and it's up to you to take the time to try to find the best deal. I didn't say it's going to be easy, but there's always a deal out there. The best deal is no deal. When I say no deal is freeze your spending. That's the best deal. You don't need the fancy, the latest, greatest fancy thing being sold by Temu or any of the other. Well, here it is, the 25th. I'm just going to point this out because it was conversation during Christmas. It's Amazon's new haul application. It's competing with Temu and Stein and AliExpress. It's all the junk that's made in China that we throw away, that we buy and we throw away. It's all this $20 stuff that it has a life of about 30 seconds. And because it's a convenience or inconvenience factor, we don't return it. We know it's junk. We know we're going to get the utility function is about 40 seconds. We know that. And we go ahead and we justify that as a smart investment. It's junk. Just stop doing it. All right. Or return it. And most people are going to go, I'm too busy to package this thing up and head over to FedEx and return it. So we're stuck with that, and we do it over and over and over and over and over and over and over. I know a lot of people would do that, and more power to them. But again, it's against the rules of frugal finance, and pay attention. You're going to see more and more of this stuff available because, well, people love it. Brad Williams, Frugal Finance, home equity loans and home equity lines of credit. Tell me your stories. Tell me if you've had a bad situation, or tell me that, yeah, I've got a home equity line of credit. It works great and it serves its purpose. Or a home equity line of credit, I took it out to do some home improvements and things have turned really ugly for whatever reason. Brad Williams, Frugal Finance. Williams out.